Welcome to another video. Merry Christmas. I hope everybody's well, safe, and spending time with family and loved ones. Thank you so much for getting me to 100,000 subscribers. We just got this plaque a couple days ago. It's amazing. Thank you so much. I mean, it's literally as much yours as it is mine because without your support, this channel is quite literally meaningless. So thank you for this. But even though it's yours, I get to keep it. Now, jokes aside, let's talk business. Now, in today's video, I want to talk about the stock that a lot of people see every day, but don't see the upside. Now, you know me. I'm not a day trader. I'm a conservative, long-term value investor. I'll only invest in companies that will allow me to sleep at night knowing my money is in good hands and is appreciating. Now, today's video, I want to talk about Apple. I know Apple is a giant. I know you probably know the stock. However, I think that based on what I'm about to show you in this video, the stock is undervalued by about 25%, give or take a few percentage points. Now, the reason being is because people don't understand the upside of the future of Apple. Now, a lot of people think about Apple as this giant that's kind of stagnating. I mean, they're selling iPhones. They're pretty much stagnating as far as revenue. There's not a lot of upside and growth. And at $132, it seems pretty stable. However, I think Apple is going to explode out of the stratosphere in the next 3 to 4 years. And I think this is the time to get in early before that happens. And in this video, I want to share with you my perspective why I think it's going to happen. However, as always, you have to do your own research. You have to do your own due diligence because this is just my opinion. Might be wrong. Might be the ramblings of a madman. Who knows? Do your own research, allegedly, blah, blah, blah. Now let's get started. Now, here's the thing about Apple, and a fair disclosure before we move on, Apple is actually in my portfolio. I actually do own Apple stock and I plan to buy more. Now, Apple actually has the 4 things I look for in every single company. It has great business model, pristine financials, very good consistent cash flow, and a lot of growth, a lot of upside. Now, granted, the 4th point is a little bit subjective. Growth opportunities and upside is in the eye of the beholder. But in this video, that's exactly what I want to do. I want to share with you my vision so you get a glimpse into the growth opportunities I see. So for that purpose, we're going to run through a full DCF. We'll go through the financials, through the business model, through everything. So sit back, enjoy, and let's get this done. Now, here's the thing about Apple that a lot of people don't understand. Apple is a traditional powerhouse in selling hardware, iPhones, Macs, and whatnot. Now, recently, about a year ago, they started making a push into digital services for good reason. First of all, the margins are much better. Also, it diversifies their portfolio as far as products and services, a lot of reasons. However, their push is only getting started. So the numbers they have right now and the share price they have right now reflect what Apple was about a year ago, which is a hardware company stagnating after a huge growth in the past decade. Now, right now, Apple is phasing out that industry and going into the digital services industry. And it's not going to be an easy push at all. It will require a lot of resources, a lot of money, and a lot of time. And it's definitely not guaranteed. But think about it this way. Right now, Apple TV, which is their streaming service, has about 2% of the market. 2%. It's nowhere close to Netflix, YouTube, Amazon Prime, and Hulu. I mean, it's not even in the neighborhood. It's irrelevant. Now, they just launched it a year ago and it's just in its diapers. But I mean, that service in itself is definitely going to grab more market share as Apple put in more resources, time into the service and actually creating original IP. Now, if you take a look at Disney, Disney proved one thing to the industry. If you have quality original IP, you'll get the subscribers. Everybody thought that the market was oversaturated, but when Disney Plus came in, they literally quadrupled their expected numbers because they had a lot of great IP, original IP. Shout out to The Mandalorian, by the way, a phenomenal TV series. I'm sure a lot of these numbers came directly from The Mandalorian. Now, Apple TV doesn't have that library. In fact, they don't have anywhere close to that. They have a couple of good titles, but mainly it's a hot pile of garbage. Now, Apple TV will have to make a push, meaning they would either have to develop it in-house or acquire an existing library like Disney has. Now, price-wise, it's going to cost the same, a lot. However, if you actually acquire an existing library, that's going to save you a lot of time. Now, they have been in talks with MGM about buying their IP. And in fact, now with Disney Plus actually blowing out of the stratosphere, the talks and the negotiations with MGM might actually go forward because now Apple can actually put a lot of value into this deal, even by spending a lot of cash. Now, whether Apple actually decides to buy MGM or somebody else or just develop it in-house, they'll get it done. I'm not even concerned about it. The question is how fast it's going to happen. I think within the next 2 years, you're going to see a steady push as they try to get into the top 5, which I think they will. But also, you have to remember, they just announced the Apple Car. That's going to be a huge project. However, Tim Cook has a great record of under-promising and over-delivering, which is a great thing to have. Everything he said he'll do, he did, and he delivered. So we know that Apple can definitely execute. And we know that if they said they're going to do the Apple Car, this thing is going to have plenty of value. It's going to be innovative and it's going to be a killer product. So I definitely see a lot of upside in the Apple Car, but this is a long-term project. This is not going to come anywhere close before 2024, 2025 at the earliest. A lot of capex, a lot of time. To build a car from scratch takes a lot of time and there's a lot of growing pains. You could just ask Tesla. It's not easy. And here's the thing, don't get it twisted. By me saying that the future of Apple is in services, I'm not saying that they're going to stop doing hardware at all. In fact, I think they're going to do a lot of good things in hardware. The 5G modem just came out. They're rolling it out in 2021. It's going to pretty much replace what Qualcomm had pretty much a monopoly on. So that's going to be huge. So as far as the hardware stuff, the modems, the 5G stuff, the car, that's all long-term projects, but I definitely see immediate value, meaning next year and the year after in services because it's easily deployable, it's quick, not to mention, as I'm about to show you, that the margins in the services industry are phenomenal, are literally double than what Apple is making in the hardware. So there's great things there. Let me show you why. Now, here's something you need to understand. Right now, the company is heavy on hardware. In fact, iPhone alone is responsible for 50% of its revenue. That is unhealthy. That is risky. Apple doesn't want that. That is not a good situation to be dependent on one device. So they definitely want to diversify their business. All things point out to services being the next big push for growth for Apple 2021, 2022. As the whole stay-at-home trend, work-from-home trend actually gets stronger, there's going to be more Macs than ever sold, more iPhones, but also more services. They're going to make a big push for Apple TV, Apple Music, and the whole new Apple Arcade. I think that's going to be huge. And here's a quick analogy to explain what I mean. Imagine Apple as the scale, right? On the one hand, you have the hardware. On the other hand, you have the digital services, Apple TV, Apple Music, Apple Arcade, whatnot. Now, right now, about 80% of it is on one side, hardware. However, it's exponential because the other side literally has 65% gross margin, which is more than double than the 31% gross margin they have on hardware. So every kilogram or gram or pound, whatever you want to use, that's added to the services is actually worth twice its weight because the gross profit is much better. The margins are much better. So that's why I'm saying that the whole push towards services, while hardware sales will keep going up, obviously because of the stay-at-home stuff, it's going to make a great 2021 for Apple. But instead of me just talking about it, let me show you my updated full DCF. Okay, so let's take a look at the DCF. Let me run you through this. So first of all, you see this 50 thing here? This is 50 billion. I actually added 50 billion in CapEx. It's a lot. It's most than I ever did in any of my DCFs, I think, recently. The reason being, I see them investing $50 billion in CapEx in the next 5 years is because of the Apple Car. It's a huge, generational, massive, ambitious project. They're going to need 50 billion just to get it started in the next 5 years. That's why you see a lot of CapEx. Now, what I also did here, I also added 15% annual growth for the EBITDA from the 2020 and going forward. Reason being, I see a lot of growth from services. Apple Arcade is going to be huge. Apple TV, Apple Music, all that good stuff are going to generate a lot of cash flow for this company at a higher gross margin, 65 over 31. So I see a 15% annual growth. Of course, we have the tax, after tax, and then the free cash flows. Now, I'm keeping the discount rate at 12% just to be cautious. I wanted to take it down a little bit, but I decided to keep it at 12% just to be careful, just to be conservative on the safe side. I know the interest rates are much lower. I actually done a 6%, and I kind of felt that it's a little bit borderline, so I'm going back to 12%. For the EBITDA multiplier, we're getting 3.27 trillion. For the perpetual growth model, for the DCF, we're getting 2.43 trillion. It's a lot of money. And right here we have the debt numbers and the cash numbers. So we have a debt net of 75 or 74.42, and that's also will be subtracted from these numbers. This is the shares they have outstanding, 17.5 billion, and here we are at the target pricing. So as you can see, the EBITDA one is 187, the perpetuity one is 139. Still, the average is 163, which is 23.5% higher than the current price. So, based on my DCF, which I think is kind of conservative, but also actually takes into account the massive growth opportunities, there's 23.5% in Apple today. It's literally a blue chip stock with 23.5% upside, which is unusual. That is why I'm staying in, and I'm probably going to buy more even at this price. And now let's take a look at the financials. Now, here's something I want you to see. If you just take a look at the financials, you'll see the stagnation. This is the numbers from 2018, 265. This is, by the way, net sales, then 260, and then 274. This is the definition of stagnation. There's not a lot of growth. It's an old company. They're basically just doing the same thing, printing money. There's not a lot of innovation and growth there. However, I do want to show you something interesting. This whole thing is based on their old model, which is this one. Look at this. Now, these are the sales of the hardware. All of this. This is hardware, hardware, hardware. This is all hardware. Out of the 274 billion, only 53 is actual services. So a tiny little percentage is just services. Most of it is hardware. Now this portion is going to go way up while adding 65% gross margin on every single dollar. So you're going to see these numbers go significantly up as these services wake up, because Apple TV is literally non-existent. Apple Arcade is brand new. Is a lot of upside in these services, and you're going to see this number going up while these are not going down, because people are working from home. They're living at home. They don't go out. The whole stay-at-home trend is actually continuing. I don't see it slowing down anytime soon. So as hardware keeps the same levels, the services will go up, creating a massive exponential growth effect. And now let's take a look at the balance sheet. That's kind of the health card of the company. So when I see how much they have in total assets, which is 323 versus total liabilities, 258. So they definitely have a huge margin, especially given how big these numbers are, which is insane. So there's plenty of margin here. They're much more than solvent. Of course, that's Apple. I'm not surprised. They're very financially healthy. However, there is a lot of debt here. Hey, how many companies you know that can borrow 100 billion? I don't know of a lot. Apple did it, but I'm not concerned because they have so much assets, so much cash flow, so much cash on hand. They have almost 40 billion on hand. I mean, I'm not really concerned about it. That's the cash, 38 billion. Sorry, I was wrong. I mean, I'm not concerned. I think the debt is just a tool for them to leverage. It's a great company. I mean, the financials are pristine, probably as pristine I've ever seen. Everything looks great in that respect. This is a very good company, very old company that already had one growth stage and now is actually priming for a second one. And because a lot of people are not identifying this on time, as I think I do, there's a huge upside in the stock because it hasn't been baked into the price right now. At $132, I think it's a great opportunity to get in on the next wave of Apple, which I think is coming next year and in 2022. So we just saw the financials and the DCF, and here's where I think Apple is headed in the next 5 years. I think they're slowly going to trend towards the printer model. They're going to use the iPhones as a delivery method to the things that actually make them money. They're not going to focus heavily on actually generating profits from these iPhones, and are going to use them as a driver for their services, much like printers for ink, much like gaming consoles for game sales. The iPhone is not going to make a lot of money, but it's going to be a great platform to actually sell digital services. And that business model shift from the hardware model to more the printer and ink model for Apple in the next 5 years is going to make a lot of sense because the margins are going to go up. The diversification of the products will go up. It's going to be a whole new chapter of growth for Apple. At least that's how I see it. And that's why I see at least 25 to 30% right now, even though it's a blue chip established company. Again, just my opinion. Do your own research. As always, a huge thanks for everybody. Thank you for the support. We'll see you guys after Christmas.